Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by Takahiro Sekido, Chief Japan Strategist for MUFG. It's Monday, January 30th, 2023. Welcome back to the podcast, Sekido-san.
Good to be back.
Hi, good to have you. So last week, the 211th Ordinary Diet Session began in Tokyo. What should our listeners be watching for from Japan's legislature, over the session and particularly the early part of it?
The fiscal year 23 Ordinary Diet Session began on January 23rd. The session was delayed by a week compared to last year to accommodate Prime Minister Fumio Kishida's visit to Davos, and the schedule will be tighter. If the Prime Minister pays a visit to Ukraine during this session, the schedule will be even tighter. The key points to watch during the session will be the nominations for the BoJ leadership, more so than the fiscal year 23 budget and JGB issues plans. Members of the BoJ's Monetary Policy Board are appointed by the Minister of Finance. The BoJ Governor Haruhiko Kuroda has already been appointed 2 terms, totaling 10 years. The next leadership of the BoJ is expected to hail from the central bank. Hirohide Yamaguchi, who served as deputy governor under Governor Shirakawa, and Hiroshi Nakaso, who was Governor Kuroda's deputy during his first term, as well as current Deputy Governor Masayoshi Amamiya are possible candidates. Current distortion changes the yield curve, JGB yield curve. The BoJ's fixed rate JGB buying operations and control the yen swap rate curve using pooled quarter fund supply operations are all extremely complex issues. When considering someone who can handle such complexity, current Deputy Governor Amamiya stands out. Over the last few days, the probability of an Amamiya nomination has increased. According to some media, it is possible this comes from leaks within the administration.
Yeah, BoJ monetary policy is extremely complex. They have regular RIN bond buying operations. They have fixed rate unlimited. They now have pooled collateral operations, and there's stuff that I probably don't even know that they're doing. So a good point that you really do need an insider to shepherd, to sort of unwind that. Someone who perhaps came up with it, will perhaps be better to help unwind it. But that's pretty high level. So the changes that you expect. So I guess let's get into some of the specifics. How or what exactly do you expect to change under this new governor?
Since the next BoJ governor will be appointed by Prime Minister Kishida, he or she will tend to support the administration's liberal capitalism agenda. The Kojikai faction, to which Prime Minister Kishida belongs, was less powerful in monetary management. We think the BoJ's current approach to monetary policy will be made less extreme, and the massive monthly easing of Abenomics will be scaled back to some degree. If this is the case, Abenomics will not necessarily be reversed. Rather, we think it is more likely to be tweaked somewhat. It will be impossible to completely erase and neutralize the monetary base supplied over the past 10 years within a 5-year term of the incoming head. That would take at least nearly 10 years, the same as the average duration of the BoJ's JGB holdings, following all the buying of super long JGBs during Abenomics. If the new head takes office after current Governor Kuroda leaves office in March or April, and revised the joint central bank government statement, and the bank's overshooting style commitment introduced in 2016. Then the BoJ will be able to halt daily fixed rate JGB buying operations. Although this should support the yen, the US Fed's quantitative tightening will limit downsides for dollar yen. Despite all of them, we expect the yen basis to widen because of the huge underlying demand for overseas asset funding amongst the Japanese companies and investors.
Yeah, that's interesting. So you would sort of expect as BoJ monetary policy becomes less easy vis-a-vis other major central banks, the basis would tighten. So that's interesting. Interesting that you think that it still widens, because of that underlying demand. You also, made the point, which I thought was pretty interesting, that Abenomics will not necessarily be reversed, but rather tweaked, made less extreme. So sort of thinking as more of like a spectrum or continuum than an abrupt shift, I think is helpful for me at least. You went into it a little bit, but I'm curious, so you're talking about high-level policy change. I'm curious how the actual operations that support current monetary policy would change in this scenario. And also, not to talk about the elephant in the room, but, any pullback in monetary policy from the BoJ is effectively going to hurt the BoJ because they own a lot of these underlying assets. Maybe you could touch on that a little bit.
In this scenario, we expect the BoJ to gradually loosen and then stop announcing its monthly JGB buying plans, which it currently does at the end of every month. The BoJ would likely return to its traditional style of monetary operations, or the BoJ may not suspend announcements completely, but rather leave the framework introduced under Abenomics as a tool to turn to when necessary. We think the BoJ could buy more super long JGBs if the super long zone yield curve steepen. This is because growing valuation losses for JGBs would hurt the BoJ's financial conditions. In particular, the BoJ has impairment risk for its super long JGB position. This is a weak point for BoJ's financial conditions from the viewpoint of the viewpoint of public accounting. Similarly, the managing the EDF positions is a big challenge for the BoJ. The BoJ cannot give up if the Nikkei average falls too far. Losses on the BoJ's balance sheet are a big threat to the credit of the central bank. In terms of the market function stability, as well as reducing the financial impact on the BoJ, while the BoJ would not dare to halt the policy option of buying the super long JGBs and EDFs, but we think it would not buy them as frequently as before. The BoJ's pooled collateral fund supply operations are an operation tool that the BoJ has used to lower yen swap rates. However, the BoJ has to pay to control the yen swap rate spreads. Therefore, we think this is a temporary monetary operation tool. It would not turn to as frequently after revising the yield curve control operations gradually, revising the yield curve control operations gradually. We expect the Prime Minister Kishida's new style with capitalism to return to the monetary policy of 2016, before negative interest rates were introduced. If political considerations result in a more hawkish than expected nomination, then we will have to review our outlook.
Okay. So it sounds like, I guess you're making kind of 2 points here. So it sounds like the BoJ sort of dials back some of the more recent, techniques it's used to control the yield curve. And you point out that, policy perhaps looks more like it did in 2016 when the BoJ introduced negative interest rates with all kind of the bells and whistles they had to add later on to control the market. And then you also make the point that the BoJ owns a ton of super longs and ETFs, and at some point they will buy to perhaps staunch the bleeding associated with holding those positions.
Right.
So let's wrap things up. And go over explicitly your outlook across yen rate, spot dollar yen, and yen basis markets.
While dollar yen has slipped slightly, trading in a 2 yen range bound around 130, the yen's nominal effective exchange rate has declined and the yen has weakened against other currencies. Key events to watch over the near term will be the Fed and ECB's policy decisions. Here in Japan, we are waiting the official nominations for the next BoJ leadership, and a speculation of timing and candidates will clearly move the yen. We see the dollar yen trading in a 3 yen range, 128 to 131, with a bearish bias. The yen swap rate curve has risen slightly, especially the belly. Despite the massive scale of the BoJ's pooled quasi fund supply operations, this location in the yen yield curve could cause the yen swap rate curves to narrow. The pooled quasi operation do not appear to be a magic wand. Over the near term, the 2 years JGB auction on January 31st and the 10 years February 2nd could test the precision of the yen yield curve operations under the pooled quasi and the JGB buying operations. The next test will be the 30-year JGB auction on February 7th. We now see a neutral rather than a downward bias for yen rates. However, the super long end of the JGB yield curve from over 10 years could steepen and turn volatile. The yen basis curve is widened. The Ministry of Finance data for January 15th to 21st shows that the Japanese investors sold a net 35 billion yen of foreign securities. They net bought 260 billion yen of foreign stocks and investment fund holdings and net 48 billion yen of short-term foreign bonds, while unloading a net 344 billion yen of medium to long-term foreign bonds. Japanese investors have been rebuilding their positions, especially with foreign stocks and investment fund holdings, with their abundant yen funds. Foreigners unloaded a net 1.7 trillion yen of short-term yen bonds, 131 billion yen of medium to long-term yen bonds, and 83 billion yen of Japanese stocks and investment fund holdings. Tokyo securities flow data favors yen basis widening. We maintain our view for a widening of the yen basis.
Okay, so bearish on dollar yen, and downward bias for yen rate. Although you acknowledge that the super long sector could steepen, and as discussed earlier, you do have a widening bias for cross currency basis. Really interesting podcast. Ton to watch for over the next, I guess, weeks and hopefully we'll have an opportunity to update our listeners on the next BoJ governor in the coming episodes. Great stuff, Sekido-san. Thank you so much for joining us.
Okay, thank you so much for having me, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts, and reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.